Everyone, welcome to the final part of Chapter 1 in our accounting, the accounting equation. I have alluded to this equation in past videos. What it is actually, let me flip forward to the balance sheet. I'm going to put the balance sheet on here. Okay, so we've talked before about the balance sheet and how all of your assets added together on the left-hand side of your balance sheet equal liabilities plus equity. So here, total liabilities and equity added together. So your total liability 6,200, your total equity 11,800 equals $18,000. Okay, so that's your accounting equation. Total assets equals total liabilities plus the equity. Okay, so let's come back here. Okay, so what this represents is assets are something that we own, okay? So it's something that we invest in. We invest in a vehicle. We invest in a house. It's something that we own and has value. And then on the other side of our balance sheet, how did we pay for it? How are we financing those assets? It's either by us, the owners, having our own money into the company or by outside sources. So for example, again, you come back here, accounts payable, that would be somebody sold us something and we haven't paid them for it yet. So again, it's a liability. We owe that money. Maybe we bought something for our computer. Maybe it was a printer. Okay, so that's our asset, and we're liable to pay the $200 because we still owe them that money. And then maybe the notes payable is a loan from the bank. Okay, so those are two outside sources that are helping us finance our assets. So the liabilities, the amount we owe is the 6,200, and then the capital or the equity, maybe that's money that we invested in the company. Okay, so that's how we're financing our assets from outside sources and from internal, such as us investing our own money. Okay. So if we come down here, again, the accounting equation is assets equals liabilities plus our equity. So an example here that they're giving is we wanted to buy a car. Okay, so once we buy the car, that asset belongs to us. Okay, we've signed the papers, we've registered it, it's in our name, we own that asset. But we haven't completely paid for it yet. Okay? The other side of the equation, because all of our equations have to balance. Okay, so any transaction, anything that happens in our company has to balance. Okay, assets have to equal liabilities plus equity. So if we got this car, how did we finance it? Okay, 15,000 of it came from a bank loan, and 10,000 of it we took our own money that we had in our personal bank account and invested it in the company. Okay, so now all of a sudden our assets equal our liabilities plus our equity. Another way we can look at it is assets minus liabilities tells us how much equity we have in the company. So how much we own our assets minus how much we owe our liabilities tells us how much our company is worth, or the value, the equity. Okay. So again, in the accounting equation, in order to come up with our equity section, we have our capital. So how much we, the owners, have invested, and that can be a cash, or maybe we gave our company a car. Maybe we gave our company a computer. Okay, so we all have to record all of those transactions. And then, as I've mentioned before as well, the way the owner, especially in a sole proprietorship or a partnership, the way the owners withdraw money from the company because they're not allowed to claim themselves as wage expense or salary expense, they have to withdraw money. And that goes directly through our statement of changes in equity. And then if you remember as well, because our statements are merged together, when you look at your income statement, your revenue minus your expenses gives you your net income or net loss. And that goes on our statement of changes as well. So if revenue is greater than expenses, you're going to have a net income, and that's going to cause our equity to go up. But if our expenses are bigger than our revenue, we're going to have a loss, and that's going to cause our equity to go down. Okay, so transactions, a business transaction. So say we have, this is probably not a good topic of conversation, but it's coming quite quickly. So we own a snow plowing company, okay? Everything that the company does is a transaction. If they plow your driveway and charge you for it, that's a transaction. If they use their cell phone and then get the bill for the cell phone for the month, that's a transaction. All of these transactions, everything that happens in the company has to be recorded. Okay, and again, everything that happens, the accounting equation has to equal. So however it affects the equity, whether it's through the income statement or directly through the statement of changes in equity, or if it's a liability that's created, that side of the equation has to equal the assets side. We're going to go through some examples, and in Chapter 2, that's what Chapter 2 is all about, is the recording of transactions. This is just a little taste, so to speak, of what's to come. Okay, so for this one here, I'm not going to read all the words, but it boils down to Walker invested $10,000 into their new company. So what does it affect? Okay, so let's have a look here. So again, it has assets equal liabilities plus equity. So what's happened? Okay, Walker invested cash. So the company got cash. They got $10,000. Okay, so what happened on the other side? Equity, owner investments, which directly affects the equity section of your balance sheet and your statement of changes in equity. So you can see that with that transaction, it balances. Let's keep going. Okay. So the second thing that's happened with the company, purchase supplies for cash. Organico used $2,500 of its cash to purchase organic food supplies. Okay, so what's happened? We gave our supplier cash, so our cash decreased. So you can see here from the old balance that we had of $10,000, we gave $2,500 to our supplier. And in exchange, we got another asset called supplies for $2,500. So now that we have those two assets, they still add up to $10,000. Okay, so even though it doesn't affect the other side of our balance sheet, we still balance because one asset went up and one asset went down. So in the end, our assets of 10,000 still equal our liabilities plus our equity. Okay, so here we have supplies cost 1,100 and the equipment costs 6,000. Those are two assets. We have equipment we're going to add in for 6,000. We bought more supplies of 1,100. Add those together, we've still got the 7,500 cash. We've got supplies now of 3,600 and we have equipment of 6,000 for total assets of 17,100. Okay, so what happened on the other side? The total liabilities to canned food supply is 7,100. Okay, so we Organica paid the supplies in 30 days, but had to arrange to pay for the equipment as a loan called a notes payable. So that increased the liability called notes payable by 6,000, so like a loan, and then accounts payable for the 1,100 for the supplies. So those added together with the 10,000 gives us total liabilities plus equity of 17,100. So it balances with our assets. Okay, so for this one here, we have and sells 2,200 worth of burritos for cash. Okay, so Organico's cash increased by 2,200 because we sold $2,200 worth of burritos. So we add that to our cash to give us 9,700 plus our supplies that we had of 3,600 plus our equipment of 6,000 gives us total assets of 19,300. Okay, so what happened on the other side? Okay, so it's saying that the equity increased by 2,200. The way the equity increased is because it was a sale. Okay, we had a food service or revenue. And if you remember, because our balance sheet is linked through to our other statements, our income statement increased because our revenue increased. Therefore, our net income increased. So therefore, our equity increased. Okay. Okay. So now we have a couple more. Organico pays our landlord rent on its downtown parking space at a cost of $1,000. Okay, so we paid cash, so our cash is going to decrease, as you can see by number 5 here. And what's happening on the other side? It's a rent expense, and rent expense decreases our equity because it decreases our net income. Same thing happened with the salary. Okay, we paid a salary of 700, so our cash decreases by 700, and we have salary expense, so that's decreasing our equity by 700. Okay, and then when we add them all up again, we have assets of 17,600 and our liabilities and our equity of 17,600. Okay, I'm going to stop the video here and create another one because I'm just about to run out of time. Thanks, everyone.